Hello, Professor. This is the presentation for this week, and it's about the insights of corporate finance and how it's related to the reality. So from this class, we mainly talk about corporate finance. This is one of the most important parts of the finance domain, as whether the organization is big or small, since they raise capital for business development. They act as a broker or consultant when companies need to raise capital or considering merging or buying other companies, all of which may enhance the value of their company. They can help manage investments or suggesting a mergers and acquisitions strategy. Overall, if there is a corporate financer, they are expected to aid them find sources through which funds can be raised, expand the business, plan the future, manage money, control risk, and ensure profitability. Here are some main concepts we talked about in this class. One of the important concepts is the capital budgeting. It is the process of planning expenditures on assets whose cash flow are expected to extend beyond 1 year. Here are some approaches for managers to make decisions. The first one we mentioned in class is the net present value. This method discounts all cash flows at the project's cost of capital and then sums those cash flows. The project is accepted if the net present value stands positive. The other approach we mentioned in class is the internal rate of return. This is the discount rate that forces a project's net present value to equals to 0 and presents the expected return rate of return on a project. It is also a measurement to decide if accept a project or not. Overall, both IRR and NPV have the same result on determining a project. Here is another concept we mentioned in class. It is the cost of capital. Capital is an essential factor of a production which has a cost. The suppliers of capital require a return on their money. The cost of capital is significant for a firm to calculate, as this is the rate of return that must be used when evaluating capital projects. The return of a project should be more than cost, which can be considered accepted. One of the methods to calculate the cost of capital is weighted average cost of capital, WACC. It represents a firm's average after-tax cost of capital from all sources, including common stock, preferred stock, bonds, and other forms of debt. WACC is the average rate that a company expected to pay to finance its assets. Once WACC is calculated, it can reflect the level of risk a company should take. For example, a lower WACC means low financing costs and less risk, and vice versa. So these are the main concepts I would like to mention in this presentation. Of course, there are other concepts in our reading books and also other concepts and calculations we mentioned in class. So this concept and theory are all related to corporate finance and also related to my life. So when I worked as a financial analyst for a real estate company who own senior living facilities, we experienced a difficult time during the pandemic. since people moved out and we did not break even at the time. So one of my job was to decide how to spend the low cost to get the max returns in such a high risk period. Our main goal is to decrease expenses and increase our profitability and make sure the flow of the capital. And I think the measurements we use is all come from corporate finance and the concept I have mentioned before. And also, I think there are a lot of positions related to corporate finance between corporations, assets, markets, investors, governments, and financial institutions. I think in the future, my dream job is still serving as a financial analyst. And I think I will apply what I learned from this class to help a business realize its maximum profitability in the future. Thank you. And this is the end of my presentation.